Hi, welcome to this episode of our production. Today we'll be discussing, do you really reflect the events after reporting period? Do you really reflect the events after reporting period? In line with IAS 10, titled Events After Reporting Period, preparers of financial statements, reviewers or auditors of financial statements are required to take cognizance of the need to reflect the impact of events after reporting period. So we're going straight into the provisions of IAS 10 titled Events After Reporting Period. We'll be picking the exact wordings of this standard, take evaluation of the two forms of this set of events, and what to do with these events. So go straight to IAS 10, and I want to read from paragraph 3 on the definition of events after reporting period. I read, events after reporting period are those events, favorable and unfavorable, that occur between the end of the reporting period and the date when the financial statements are authorized for issue. I take it again. Events after reporting period are those events, favorable and unfavorable, that occur between the end of the reporting period and the date when the financial statements are authorized for issue. That is the definition of events after reporting period. Two dates are important: the end of the reporting period and the date a set of financial statements is authorized for issue. For example, if the year end ends December 31, 2023, December 31, 2023, and the authorization date for that financial statement is, let's say, April 1, 2024. So that period between December 31, 2023 and April 1, 2024 constitute the period within which these events can occur. So the events that occur between December 31, 2023 and April 1, 2024 constitute events after reporting period, because the reporting period ends or might have ended December 31, 2023. So these events that occur, as the standard mentions, they are events, they may be favorable or unfavorable, and they occur between the end of reporting period and the date a set of financial statements is authorized for issue. Now, there are two forms of these events. We'll be dealing with these two forms, and then what do we do with these events? But before that, we need to take a special notice of the need to have a date of authorization of a set of financial statements. So I want to go over to paragraph 17 to read on the need for the disclosure of date of authorization of financial statements. So I take it from paragraph 17. It provides, an entity shall disclose the dates when the financial statements were authorized for issue and who gave that authorization. I take it again. An entity shall disclose the date when the financial statements were authorized for issue and who gave that authorization. In line with the provision of IAS 10, in the wording of the qualitative information provided in a set of IFRS financial statements, an entity is required to state the date that financial statement or that set of financial statement is authorized or was authorized for issue. For that set, the date that set was authorized for issue should be stated. So that is why in introductory qualitative information about reporting entity, when we state this is the company incorporated on so date, this is the registered office, these are the principal activities, it is a set of individual financial statements or consolidated, we must state along that path to more state clearly that the financial statement of this company were authorized for issue on April 1, for example, April 1, 2004. So the requirement of IAS 10 that the date of authorization of a set of financial statements should be stated, and also the body of persons or person or structure or office that authorizes such set of financial statement. So this is a key disclosure. Now, why is this date of authorization of financial statement important? It is important because it enables a reader, a standard reader, to have in mind the implication of those events that might have occurred between the end of reporting period and that date that that set of financial statement was authorized for issue. So when a date is given, e.g., that these financial statements or this set of financial statements was authorized for issue on April 1, 2024. So when we know that December 31, 2023 is the year end, automatically we're looking out for, okay, yeah, this is December 31, 2023 financial, right? Now, what about those events that might have happened between the end of that period and the day the financial were authorized for issue? How were those events dealt with? So the dating is important before we now deal with those two sets of events that we consider events after reporting period, which may be favorable or unfavorable, but that might have arisen between the year end or accounting year end and the day the financial is authorized for issue. So with this said, we go to the two sets of events, the two broad sets of events. The first one is the one we call adjusting events. Adjusting events. In the word of the standard, I want to take it exactly the way it's stated, still within paragraph 3. So paragraph 3 gives a definition of events after reporting period as being whether favorable or unfavorable that occur between the year end and the date of authorization. It now states these two sets of events. The first one is those that provide evidence of condition that existed at the end of the reporting period. There are some events, the information becomes available after the end of the reporting period, but before the financials are authorized for issue. So it's about informational availability, informational awareness, fullness of information of certain conditions or events or transactions or developments that had occurred as at that year end. Those are called adjusting events. So the standard states that those that provide evidence of conditions that existed at the end of the reporting period. So that definition is given in paragraph 3A, and it reinforces it in paragraph 8, explaining adjusting events as a reporting period. It states an entity. Now, what is an entity to do? Okay, before that, let's look at what are those events that could provide information that point to the fact that certain condition already existed at the end of the reporting period. If an entity had a court case within a year, which had been previously been reported as a contingent liability, for example, maybe based on the legal estimation of the potential financial implication of a litigation against an entity, that entity might have disclosed, because contingent liabilities are not recognized, then they might have disclosed contingent liability in the period associated with such litigation. But after the year end, when a ruling has been made within this period we've discussed, the end of the accounting period and the date of financial authorization, say for reporting year end December 31, 2023, a court has given a ruling sometime in February, stating or ruling that an entity is liable for so and so amount of money, maybe as damages, right? Now, the condition that existed at the year end or by the year end, December 31, 2023, the court has just given a ruling in February of 2024, the following year, but before the date of authorization. That is a typical example of an adjusting event. An adjusting event, because the condition, the contingency, the events that gave rise to the existence of a contingent liability had existed as at or before the accounting period end. It has happened that subsequently, before the date of authorization, the court has ruled concretizing that liability, taking that liability away from being a contingent liability to a liability, or for which a provision should be made, as the case may be. That's an example of an event after reporting period. Common example are errors, where errors are discovered after the end of an accounting period, but before the financial authorized. All form of errors of omission, commission, overstatement, understating, non-recognition, all those kind of error that, all those kind of errors that come up as the firm and the auditor, do a final review and a conclusion. All forms of errors that come to the limelight between the end of an accounting period and the date of authorization all fall within events after reporting period that are adjusting events. Common example, errors are by far the largest category. Common example also are errors, frauds, where frauds are discovered. If there had been a theft of a certain sum of money as at year end, which was not known but was known later on, that condition of theft, as in the case of error committed, had existed by or at that year end. It's just a case of fullness of information, coming to know about the information afterward, but before the financials are authorized for issue. So those are events after the period which are classified as adjusting events. So what does that mean? For all adjusting events, with the knowledge of the development, with the full receipt of information, with coming to be aware of the crystallization of the clarification of development concerning condition that existed at year end, an entity goes ahead, a preparer goes ahead to adjust the financial statement to reflect those developments. For the errors, the appropriate errors are corrected in the financials, and the affected line items are re-ascertained accordingly. For fraud, the effect of the fraud or frauds are reflected in the financial statements. A case where a provision needs to be done on what has been considered to be a contingent liability, the appropriate recognition of provision is made. So for adjusting events, they are reflected in the financial statement. Even though the information is coming afterwards, meaning after the accounting year end, so long as that condition, that matter, that development had occurred or existed as at that year end, coming to the receipt of the information, coming to full knowledge of the information, coming to the exposure of the information, coming to the revelation of that development afterwards, but before authorization, make them adjusting events, and those financials need to be adjusted accordingly. Now we go to the second set, which are non-adjusting events. We've discussed adjusting, non-adjusting events. So I take it in the word of the standard, it states, those that are indicative of conditions that arose after the reporting period. There are some conditions, the first one we analyze, the condition that existed as at a year end or before a year end, they existed, but it just crossed the line by way of information awareness or availability or clarity or certainty. But the other set, those set of information, those set of development that arose after the reporting year end. After reporting year, so the standard states, those that are indicative of condition, they reflect the condition that arose after reporting period, but before the date of authorization. For example, inventory has been taken, evaluation is done December 31, 2023, then sometime in March 4, 2024, there was a fire outbreak that burnt up all the inventory. What happened? The inventory existed as of December 31, say 10 million naira. Unfortunately, there was a fire outbreak in March 2024, burning up all the inventory. And maybe for which there is no insurance, for example. What happened? In that case, the event that has occurred is a clear case of condition that arose after reporting period. Therefore, even though that financial has not been authorized, it is not, the development does not lead to the adjustment of the position of inventory. Everything is left the way it is. That is the quantitative implication of non-adjusting events, they do not lead to the adjusting of any line item or any of the 5 elements of financial statements in the face of primary financial statements. They are not. So that's an example. When there's a destruction, for example, when there's a theft afterwards, when there are commitment, when there are purchases of additional assets upon existing one, any development that indicator of condition that arose or that occur after the reporting period, they are called non-adjusting event. In summary, they are not, those developments are not reflected by way of affecting the monetary amounts of all the 5 elements of financial statements. Therefore, with the knowledge of adjusting and non-adjusting events, what does the preparer do? Or what is the preparer required to do? You see, most financial statements, some may be prepared in arrears. We see 2 years, 3 years, such a financial statement being done in the current year. They are purely historical reporting. For instance, a 2024 financial statement, a 2019 financial statement, 2018 financial statement, 2017, 2016, probably for entities that have never kept record accordingly. When 2016, 2017, 2018, and 2019 financials are prepared afterwards in the year 2024, they are purely historical. So what does the preparer do with this knowledge and prescription of event at the reporting period? That is why it is important. Most historical financial, when you read the statement or the disclosure or the notes on event at the reporting period, they often state there are no events at the reporting period. How can a preparer of financial in 2024 that pertain to 2016, 17, 18, 19, even up to 23, years after, or the latest being 6 months after, state that there are no events after reporting period? That makes it questionable, absolutely questionable, because there will be many events. Some accounts are far too historical to even be relevant for the current period. So that is the essence of the event after reporting period. All those developments that have occurred after the end of the reporting period and the date it is authorized for issue. For example, if an accounting year ended in December 31, 2015, and that financial or the financials have been prepared and authorized for issue in 2024, event after reporting period covers that period between December 31, 2016, for a 2016 year end, up to the month in 2024 when the financial was authorized for issue. That is what is done. Nothing more. Therefore, a typical preparer should take note that there is need to reflect these developments. There is need to reflect the development. So is there a case of having nothing to say or having nothing to write? So for those that are adjusting, they should be reflected in the 5 elements of financial. For those that are not adjusting, they should not be reflected. And what does the standard say? We go over what are you to do. So we said it in part, but finally we take it in the word of the standard. If an entity receives information, this is paragraph 19 of IAS 10. If an entity receives information after the reporting period about conditions that existed at the end of the reporting period, it shall update disclosures that relate to those conditions in the light of the new information. So where the adjusting events, the adjustments are done, meaning the appropriate line items, element of financials are reflected for the adjustment, 1, and 2, like every other disclosure required for a line item in an IFRS accounting standard set of financial statements, disclosure appropriate to those changes or to those developments arising from the event should also be disclosed. If the events are about inventories, the disclosure of inventories should be updated for those developments. If the events are about cash and cash equivalents, the disclosure on cash and cash equivalents should be updated accordingly. If the events about financial, say bonds, short-term investments, biological assets, intangible assets, property, plant, and equipment, contract liabilities, lease liability, right of use asset, whatever the line item is, the events that warrant the adjusting of those line items will have to be followed up with an updated disclosure concerning that portion of the development. It is just the usual disclosure in line with the adjustment that is being made or that is to be made or that has been made. That is the provision of IAS 10 concerning adjusting events. What are you to do? In addition to adjusting, the appropriate updating of disclosure should be made. We go over to non-adjusting events. What should be done on non-adjusting events? Paragraph 21 provides, if non-adjusting events after reporting period are material, the concept of materiality in a second is defined under IAS 1, right? Materiality, misstating, omission, obscuring, right? So that concept should be considered in the context of IAS 1. So I read on. Paragraph 21 of IAS 10. If non-adjusting events after reporting period are material, non-disclosure could influence the economic decisions that users make on the basis of the financial statements. Accordingly, an entity shall disclose the following for each material category of non-adjusting event after reporting period. What are you to disclose? A, number one, the nature of the event. What is the nature of the non-adjusting event? State it. Court case initiated against the entity after the reporting year end. Thefts after the year end. Destruction after the year end. Losses after the year end. Developments. Discontinued operation after the year end. All of these are events that do not warrant adjusting. So they are non-adjusting events. So an entity discloses the nature of the event. That is the first part of the disclosure required, or of the disclosure required on non-adjusting events. That's number one under A. B, an estimate of its financial effects or a statement that such an estimate cannot be made. So when there are non-adjusting events, even though those events are not adjusted in the financial at reporting year end, it is required ideally that an entity does a quantitative implication of those events if they were to be adjusted. And it does a quantitative, a monetary implication of those events if they were to be adjusted. How would those events have affected the profit and loss for the year? How would they have affected the equity for the year, for example? Or how have they affected the cash flow for the year? So those are the things the standard require us to do with respect to favorable or unfavorable non-adjusting events. It's about disclosure, to disclose the nature of those non-adjusting events, and then the financial effects of those non-adjusting events, or where we're unable to come up with the financial effect, to state that the financial effect has not been ascertained. Now, the beauty of this second provision on disclosure on non-adjusting event is that when you are reviewing a financial that is 6 months old, account year end December 31, 2023, and is being made available authorized on June 30, 2024, 6 months have gone. So technically, the account is stale. Not stale in terms of legality, no, or jurisdictional staleness, no. In sense that information is too historical and far away. So the import of this second disclosure give us a financial simulation of the effect of all those developments that have occurred between the year end and the authorization date of that financial. That is the timeline. We want to know the likely effects of those events that are non-adjusted on the financial that you are prepared. That is the importance of the request to give the financial effects of such non-adjusting events. Alternatively, for certain reason, an entity cannot, the entity also allowed to state that the financial effect has not been reflected. Lastly, it's important to note, it is possible that within an accounting year end, an entity is a going concern. However, between the end of the accounting year end and the date of the authorization, the entity might have ceased to be a going concern. Going concern within the accounting year end outgone up to the end of the accounting year end, but before the reporting year end, to the date of authorization, the entity might no longer be a going concern. Recall that under IAS 1, the going concern status of an entity is required. Therefore, under IAS 10, when there's a going concern question, when an entity is no longer a going concern, as a result of the events occurring after the end of an accounting period and the date of the authorization of a set of financial statement, then it is required to state that. And by that very fact, when an entity is no longer a going concern, the meaning is this: there's no continuity. There's no continuity beyond the next 12 months from the date of reporting. And therefore, the measurement basis of all of the assets may need to be prepared using what can be called, largely, apart from the current and apart from the cash and cash equivalents, all other assets will have to be dealt with based on their realizable value for an entity that ceases to be a going concern. For an entity that ceases to be a going concern, all assets except for cash and cash equivalents that are already liquefied or semi-liquefied for the cash equivalence component, right? All other assets will be measured based on their realizable value, because it's now about, it becomes a case of winding up, liquidation, or receivership, as the case may be. So that is it. So it is important to also do the disclosure concerning going concern. If that question arises of an entity no longer being a going concern between reporting year end and the dates of authorization, even though the entity had been a going concern be within and as at the year end, before the going concern issue arose afterwards, when the financials were supposed to be authorized. So that is it on this side. Thank you for joining us. It's a long one, but it was necessary. We look at the various sum and what to do in terms of disclosure, the going concern issue, the adjustment for the adjusting event, and the non-adjustment for the adjusting event. You need to disclose the nature and the financial effect or quantitative impact if the non-adjusting event were to be reflected. How does that affect the profit and loss for the year? How does that affect the equity? Or how does that affect the cash flow of the entity by the virtue of their existence? Thank you for joining us on this episode. Continue to watch our video, like them, share them. Please subscribe to our channel and share them widely within your professional network. Thank you once again. My name is Audio Samuel. Bye for now.